A few weeks back, I posted a video about a potential US plan to revalue its gold reserves to help pay down debt. I received a lot of questions and comments. It was clear many people didn't fully understand the mechanics of how this could occur or the historical precedent. That's on me for not being clear enough. So this video dives a little deeper and answers those questions about how this could happen and walks through the actual mechanics step by step. First, a quick review of where we stand today. The US is $38 trillion in debt, and it's growing. To put that into perspective, the debt increases by over $6 billion per day, over $250 million per hour, and will increase by another $40 or $50 million by the time you finish watching this video. Current US GDP is around $32 trillion. That puts our debt to GDP ratio at about 120%. A widely accepted manageable debt to GDP ratio is closer to 70%. That would require reducing our debt down to about $23 trillion or $15 trillion less than it is today. The US holds roughly 261 million ounces of gold, currently priced on the books at $42.22 per ounce. That adds up to about $11 billion. Why so low? That price was set by law back in 1973. Today, gold trades around $5,000 per ounce. At that price, US gold reserves are worth about $1.3 trillion. But what if the US revalued its gold reserves to a higher price, say $20,000 per ounce? Then it would be worth a little over $5 trillion. But how can the government revalue gold above market price? That's where history comes in. The US has already repriced its gold reserves 3 times in the last 90 years, and never to market rates. Each time, the gold reserves were repriced based on a policy or accounting decision. In 1934, under Executive Order 6102, FDR required all U.S. citizens to turn in their gold, coins, bullions, certificates. They were paid $20.67 per ounce. Then Congress passed the Gold Reserve Act, and gold was repriced overnight to $35 an ounce, a 69% increase. That wasn't a market price. It was a policy decision designed to devalue the dollar, raise the value of Treasury gold, and create inflationary pressure during the Depression. In 1972, in conjunction with Nixon closing the gold window, U.S. gold reserves were repriced from $35 to $38 an ounce. This also wasn't the market price of gold. It was done by law. Gold was already trading well above $40 in private markets. The $38 figure was a cosmetic adjustment meant to preserve the illusion of order and support a fixed exchange framework. This was a political adjustment, not a repricing to market. Finally, in 1973, U.S. gold reserves were repriced from $38 to $42.22 an ounce, where it sits today. At that time, gold prices on the open market ranged from $90 to $120 or more per ounce. Why price it so low? Because the statutory price mattered only for accounting. The US no longer intended to redeem gold for dollars. It had no incentive to mark gold to market. This was an accounting fiction, not a true valuation. Each time, the government set those prices, not the market. Congress can set the statutory price of US gold reserves to whatever amount meets policy goals. They're not constrained by the market price. Theoretically, Congress could revalue U.S. gold reserves to $30,000 per ounce tomorrow. Now let's walk through the actual mechanics, because this is where many people got lost. The authority to do this already exists. The Federal Reserve Accounting Manual explicitly states, "The Secretary of the Treasury is authorized to issue gold certificates to the reserve banks to monetize gold held by the U.S. Department of the Treasury." This is what they mean when you hear them talk about monetizing the balance sheet. Here's how it works. The Treasury holds the U.S. gold reserves. The Treasury issues gold certificates to the Federal Reserve, but it can only issue gold certificates equal to the statutory price of gold. Right now, the Fed holds gold certificates valued at $42.22 per ounce, the price set by law in October 1973. The Fed then creates reserves against those gold certificates and credits the Treasury's balance sheet with the amount of the gold certificates. In other words, the Fed creates electronic money equal to the amount of the gold certificates and gives it to the Treasury. The Treasury now has new money to spend. Gold certificates exist for one specific reason: to give the Fed a legally authorized asset while issuing money tied to Treasury-owned gold. Gold certificates are an accounting bridge between the Treasury, which owns the gold, and the Fed, which issues the money. This means the Treasury can turn U.S. gold reserves into spendable money without selling a single ounce. For the revaluation to happen, Congress would need to amend the 1973 law setting the price of U.S. gold reserves. For argument's sake, let's say they revalued the reserves to $30,000 per ounce, which they can do. The Treasury would revalue gold certificates to $30,000 per ounce and reissue new certificates to the Fed totaling around $8 trillion. The Fed then creates reserves against these new gold certificates and credits the Treasury with this increased amount, roughly $8 trillion minus the $11 billion they already credited for the old certificates. The Treasury now has about $8 trillion in fresh money to use to retire debt. So yes, this can be done. The authority is in place. It's been done before. It sounds extreme, but it isn't novel. Now let me answer the most common questions. But first, a quick pause. If you're looking for stock picks, Seeking Alpha's stock picks are up over 250% since 2022, far outpacing the S&P, and they are running a Valentine special. From February 2nd through the 15th, you can get 15% off their Alpha picks with my link in the description. Now to the questions. Can the Treasury do this alone, or does it require congressional approval? This requires Congress to amend the statute setting the price of U.S. gold reserves. The President can't unilaterally change the statutory price. The President could under the Gold Reserve Act, but that authority was taken away in the 70s. If you hold gold and the U.S. revalues its reserves to $30,000 per ounce, is your gold suddenly worth $30,000? Unfortunately, no. This has nothing to do with open market pricing. This is purely bookkeeping between the Fed and Treasury. The Treasury's gold may be worth $30,000 per ounce, but your gold still trades at market price. Congress would be repricing U.S. gold reserves, not gold itself. What debt would the government retire? The government likely wouldn't buy back debt. Instead, as old debt matured, the government wouldn't roll it over or issue new debt to pay the principal as it does today. It would simply pay the redemptions out of its new money. That would have the net effect of retiring the debt. This is plausible. Between $9 and $10 trillion in U.S. debt is expected to mature this year, with more than $5 trillion maturing next year. How likely is this to happen? That's anyone's guess. It's currently discussed in policy circles but hasn't reached the upper levels of government. But the government will eventually face trade-offs as debt servicing costs rise. Taxing our way out isn't politically feasible. Neither is cutting spending. With debt at 120% of GDP and rising, this option is more likely today than it was 5 or 10 years ago. If this occurred, it would likely happen alongside other measures such as an intentional currency debasement. Currency debasement makes the debt cheaper in real terms. The U.S. could retire $6 trillion in debt, bringing the ratio to about 100% of GDP in nominal terms. That would save around $200 billion in annual interest costs. Then employ intentional currency debasement, or just let inflation run its course, reducing the debt further in real terms. Finally, if the U.S. got spending under control, a massive assumption, GDP growth over the next several years could push the debt-to-GDP ratio to that 70% target. Nominal GDP has risen by over $12 trillion over the last decade alone, so if the U.S. could rein in spending, it could happen. The real key is bending the debt curve down. And sometimes drastic times call for drastic measures. The legal authority exists, the historical precedent is there, and the debt problem isn't going away. I hope this cleared up questions from my last video. None of this is personal financial advice. This is information so you can understand the mechanisms and make your own plan. If you found this valuable, hit subscribe. We publish fresh content multiple times per week, breaking down the economy and helping you grow and protect your wealth. And keep the momentum going. Watch my video, Is the US Planning a $37 trillion Crypto Debt Reset? It's on the screen now. In the description, you'll find a link for 15% off Seeking Alpha's Alpha Picks during their Valentine's special running February 2nd through the 15th. You'll also see a link to my Wealth Builders Blueprint, a collection of resources to help you grow your wealth. And there's a link to Zacks Confidential as a more economical alternative. Check them out. Thanks for watching. See you on the next one.